My name is Hassan Yunus. I'm from Eastern Michigan University. The most important lesson I learned in the research challenge is that when you surround yourself with great people, great things tend to happen, and that when you have those people to rely on, you can accomplish way more than you thought was possible. So really just building a strong team and the foundations of working with those people was amazing. The biggest challenge we faced in the competition was actually finding the research for the industry. That was a very small industry, so it was quite difficult to find any research about, but it did teach us a lot about fact finding and how to, alternative uses. Currently, my career path tends to lead down the road of consulting. I also have an interest in investment banking, and the skills I learned during the CFA challenge will be beneficial to both of those.
Good morning, everyone. I'm Hassan. This is Steven, Yenny, Byung-hoon, and Anna. We are a team from Eastern Michigan University. This is our evaluation of Neogen stock. We are issuing a hold recommendation for Neogen stock. This is based on two separate valuations that, when combined with the weighted average cost of capital, 6.32%, gave us a 12-month target price of $43. This leaves Neogen stock with a 5% upside as of this valuation within that 12-month period, falling in line with the hold recommendation. These are the four main drivers of our valuation. The first of which is that they are growing in the lower margin segment faster. That is demonstrated by this bar chart, where animal safety is outgrowing food safety and becoming a larger portion of operating income as time increases. This is problematic for Neogen due to the fact that it has a 10% lower margin than the other one. This will reflect negatively on their income statement, as represented by this bar chart. Using historical trends and forecasting them forward, we project that revenue will outgrow operating income by up to 30% in the next 2 years. The next main factor for evaluation is the acquisitions will slow. Demonstrated by this bar chart, you can see that Neogen's 27 historical acquisitions since 2000 contribute to, on average, 26% of annual growth per year. This is a trend we believe will not continue in the future due to larger competitors looking to buy into this marketplace, which will be problematic for Neogen as they will then have to find other ways to generate this growth.
The next driver for Neogen valuation is Neogen's expansion into emerging markets. This map here shows the blue countries on this map represent developed markets where future growth is going to be slow. The red countries on this map represent emerging markets with high growth potential. Specifically in China, we do not believe that Neogen will be able to capitalize on these opportunities because they have a concern about reverse engineering of their products in China, as well as lack of understanding on how to do business effectively in China. In addition, in India represents a great opportunity for growth, and we do not believe that Neogen is positioned to capitalize on these opportunities at this point in time. The final factor for our valuation is the fact that Neogen is characteristically a defensive growth stock. The reason for this is that Neogen's revenues are protected by continuing government regulation despite the market position. Neogen is in a non-cyclical area of the market.
Based on our industry analysis, we were able to point the main supply side driver that increased government regulation globally, which are switching from responding to food contamination to preventing food contamination. This creates an increasing demand for diagnostic substances industry, which Neogen operates in. The main demand side driver is an increasing demand for meats and higher quality foods in emerging markets. This graph represents the decreasing meat consumption in developed countries. This means that Neogen's growth in these markets will become flat. In contrast, this bar chart shows that the meat consumption in emerging markets will increase. For example, the meat consumption for China will increase 17% from 2012 to 2022. This is a tremendous opportunity, but we don't believe that Neogen will be able to seize these markets in the near future.
And shown in this table, Neogen has much smaller market capitalization in comparison to the industry average, and it's the largest competitor IDEX. This means that Neogen could be a potential acquisition target for the larger companies which are looking to enter into the market with the historically high profit margins. And this is reinforced by the management's comments that larger companies have already made proposals to acquire Neogen. And the Neogen's P/E ratio is almost double to industry average, and is slightly overstated at 50 currently. This means that the company will have to either incrementally increase its earnings up to the rankings, or the stock price will need to fall down in line with the industry down the road. And the operating margin is less than the industry average, which means that the company is not capable of generating enough operating returns as strong as the competitors do. This is likely because the company is growing less profitable segment at a higher rate. And the two main factors that affect Neogen within the industry are the threat of new entrants and the intensity of rivalry. The threat of new entrants is high because of the historically high profit margins, and these attractive margins will drive companies to move their capital into this industry in an attempt to gain market shares. And the intensity of rivalry is also high because Neogen is competing against the larger companies which have the larger research and development budgets compared to Neogen. And in addition, there are small single companies which are competing against one or a few products of Neogen.
Upon completing our financial analysis for Neogen, we recognize that Neogen is growing fast in a lower margin segment. This is largely attributable to Neogen acquiring some companies in the animal market segment. Although acquisitions have historically attributed to a large percentage of growth for Neogen, we do not believe that this trend will continue into the future, due to the large companies entering the market, and thus this will help Neogen which will be the cause for Neogen's decreased revenue. Neogen has also increased its sales and marketing department by 8% over the past couple of years, as well as the revenue, the R&D has been a major driving factor for Neogen. Historically attributed to 33% of the organic growth, but we believe that this will be a major driving factor for Neogen's growth into the future, as acquisitions will be slowing down. If you look at this chart, you can see the Neogen, its main competitor IDEX, the Nasdaq Composite, and the Nasdaq Healthcare historical returns. As you can see, over the past 2 years, Neogen stock price has been decreasing and reverting back towards the mean. This is indicative of our evaluation that Neogen's growth will be slowing down into the future.
As mentioned previously, we used a two-pronged approach for our valuation method, the discounted cash flow model as well as the PE multiple pricing method, each equally weighted at 50%. For the discounted cash flow model, we used the following assumptions: a risk-free rate of 3%, a beta of approximately 1, market risk premium of 3.5%, and our weighted average cost of capital of 6.3%. Our total growth in the first year of our model was 12%, 8 percentage points coming from animal safety and 4 percentage points coming from food safety. We used a 20-year forecast horizon. This specific length of time was chosen in order to capture enough of Neogen's growth. A shorter forecast horizon would not have been able to capture this. We use a linear smoothing algorithm throughout for the 20-year forecast horizon until we reached our terminal value of 3%. This slide here is a summary of our discounted cash flow model. This valuation method, when deployed, determined a price of $38 per share. This is a sensitivity analysis of our discounted cash flow model. It shows the relationship between the sales growth as well as operating margins. This sensitivity analysis shows us that in order for Neogen to significantly increase its value, it would not only have to increase sales growth significantly, it would also have to increase operating margins significantly. What this would mean would be generating higher revenues with significantly lower expenses. This is highly unlikely. The second method we used was a PE multiple pricing method. We used the trailing 12 months earnings per share and multiplied it by the current PE ratio. This gave us a valuation or a price of $44 per share. When combined, these two methods equally weighted at 50% each, our price at the time of our valuation for Neogen is $41. In addition to our valuation, we like to recognize that since our valuation, Neogen stock price has been on a run and risen significantly. However, we believe the reason for this significant increase in stock price is the euro dollar's drop in value. Investors have been moving their money from the risky euro dollar into safer assets with little international exposure, such as Neogen. And this stock shows a negative correlation between the two. Thank you.
Hi there. I have a question. Of their 27 acquisitions since 2000, how many have been in animal safety and how many have been in food safety?
We're not sure of the specific number. The majority of the acquisitions have been in animal safety.
So the lower margin business.
Correct. This is due to there's more demand for that area in the marketplace, so it's easier to smaller companies to target new products in that area. So there's more smaller companies for them to acquire in animal safety versus food safety.
So your thesis is not to own the stock because they're growing at a greater rate in animal safety than food safety, right? Because it's a lower margin business?
Yes.
Okay. Were you able to look at the operating margin trends of the companies that they acquired to see if they were able to get margins up?
No, we did not examine that, but we do understand that most of the growth and cash driven for Neogen is from these acquisitions. When they make an acquisition, they usually buy companies that have larger sums of cash, so that kind of helps their income statement and their balance sheet out a little bit. But I couldn't look at the exact operating margins of those.
Do you have a realm for their addressable market, their market share on animal health versus food safety?
I'm
sorry. Their market share?
Their market share?
Correct. Of the addressable market. So under your premise of animal health slowing, that's kind of the...
The way the industry was categorized, it was kind of all sumped into diagnostic substances is where they identified themselves. So splitting that up into further segments was, very difficult for us to find accurate numbers, as it wasn't, we didn't trust the numbers that we did see.
You mentioned IDEX is one of their big competitors. What's the percentage of business that IDEX does in animal safety? Do you know as far as total sales compared to Neogen?
While IDEX is their most similar competitor, it is not a direct competitor of Neogen. They are in other lines of business, so they have multiple segments versus Neogen, who only has 2 segments. So they are a much larger company, but it's a different breakdown. It's not a 49 or 59. It's probably in fractions of 20 because they have so many.
And you mentioned that the larger competitors are going to be getting into Neogen's basically markets.
Yes.
So you're able to. So when you were looking at the valuations, were you also doing research on IDEX as well?
Initially, yeah, we did research IDEX, and we also tried to research Charms, who is another competitor, but they are a private company. So acquiring information about them was quite difficult. But the trend shows that larger companies are looking to buy into this marketplace. When we spoke with management, they addressed that even they have been approached by other companies as an acquisition target. But their defense was their high PE ratio made them quite expensive. So if a company is looking to buy them, they must have a lot of capital.
From a management standpoint, you guys spent several hours with investor relations and members of management. Any outtakes from that as far as the presentation goes, as far as the quality of management as an input to the valuation?
We believe that they have a strong management team, and going forward, it'll begin to become even stronger. They specifically discussed how they're moving to a more modern, traditional approach in management. So they're hiring more managers, more CFA. So they're moving from a less traditional to a more traditional management structure, which I think will benefit them going forward.
And the founder is Jim, who's 75. Is that another input from what you? He's an awesome guy. But was that another input as far as?
Well, yeah, his age does really show in the way Neogen conducts business. For example, they carry no debt at any time. So this makes it problematic when you're looking at when these acquisitions are going to become more expensive in the future. Since they don't like to finance with debt, they're going to have to spend more of their revenue on those acquisitions, which could hurt the company if they choose to continue without that debt portfolio. But the younger management that we spoke with said that they would be willing, yet we we have no reason to believe or disbelieve that statement because there have been no examples of it.
They are also in a position, if the opportunity presented itself immediately and they needed to take on debt to acquire a larger company, they're already positioned to do that. They do have a line of credit with Chase Bank for $12 million with $0 drawn on it currently.
And from a valuation standpoint, the fact that they don't have any debt, did that affect the metrics you were using on the weighted average cost of capital or discounted cash? I mean, all that stuff, what type of input did that make?
The weighted average cost of capital was essentially, the cost of equity for the company. So it impacted it by not having any weight towards the weighted average cost of capital.
Correct.
What is Jim's percentage of ownership, the 75-year-old founder?
I'm not specifically sure of Jim's percentage of ownership. However, management as a whole has a very small percentage of ownership. I think it's under 3%.
About
3%, yeah.
About 4%. And recently, one of their managers bought a whole bunch of Neogen stock and then released it. When they're making the run, he bought it early and then released it again. So the management, I mean, they have a small share in it.
From the pricing of their products, and you guys delved into the products that they have with diagnostic tests, a lot of they are not high cost products, so there's kind of a razor blade model. Did that get thought about as far as how you value the company in terms of?
What exactly do you mean by razor blade?
Like the percent, like recurring revenues.
Recurring revenue?
What we believe is that Neogen's customers are going to continue to keep purchasing their products. One thing that management specifically addressed was they spend a lot of time setting up a customer base and building a customer relationship. So they will come into the business that they're selling their products to. They'll set up the process to show them how to use their products. So once someone has purchased Neogen's products, they're quite invested in continuing to use it. So going to another company would have a high cost because they'd have to spend the additional money training new employees on how to use the different products. So we believe Neogen's customers are going to continue to keep purchasing their products.
So are there any customers that represent greater than 5% of total sales?
No.
One of your main premises was the amount of acquisitions that they've done, and that would just suddenly kind of stop. And yet, for the size of the company, what 1.7 billion market cap in a very dispersed industry group that, granted, is tough to find information on, and we get that because other big companies have divisions part of it, but couldn't they keep growing and buying people? That's kind of in their DNA.
Well, we didn't say that acquisitions will stop. We believe they will slow. And this is due, they have acquired 27 since 2000. So the law of economics kind of kicks in at some point where you believe that they have already acquired the majority of the best products out there. So believing that, we think that that pace is too aggressive. And with the competition trying to buy in, these new acquisitions are going to be more costly. And that goes back to management's dislike of using debt to finance those activities. So we believe they'll be hesitant to spend large sums of money on newer acquisitions. We're not saying that they will just suddenly stop. We believe that it's a tail down, kind of to focusing more. Big concern of management was they want to focus more on their R&D, which will help them grow more product line instead of growing their product line through acquisitions, which I personally believe was going to be that they would execute on that.
In addition, I'd like to add something to what Hassan said. The way we treat acquisitions in the valuation is that we believe, like he said, they will continue, they will slow. However, it's very difficult to assume whether they'll be able to acquire companies how it will affect their revenue growth in the future. So the acquisitions were treated to be neutral. They won't affect growth and they won't hurt growth either in our valuation.
We also believe that any future acquisition would be done at a fair market value, so not affecting our DCF model.
Thank you so much.
Thank you.
Thank you.